We are seeing a lot of green on the screen for Navitas Semiconductor, NASDAQ ticker NVTS, which is currently trading at 13.58 US dollars. That is a very strong move for the morning, up 5.85% or 75 cents in the first hour of trading. The stock gapped up at the open and has been climbing, pushing towards its session high of 13.62, coming off a low of 12.89. This is a stock that has been on an absolute tear, and today's move just seems to confirm the bullish narrative. But the real story here isn't just today's 5.85% jump. The most critical number for Navitas right now, the one that defines the entire bull and bear case, is 24.6. That is the percentage of this company's entire free-floating stock that is currently sold short. While retail investors are cheering this morning's rally, a quarter of the market is holding a position that bets this stock is going to fall and fall hard. This makes Navitas one of the most intense battleground stocks in the entire semiconductor space. Let's first establish the expectation, the common ground for why so many are so excited about this company. If you ask a Navitas bull, they will tell you that this is the ultimate picks and shovels play for the artificial intelligence boom. They'll tell you that while everyone is fighting over buying NVIDIA, Navitas is the company making the critical components that will allow NVIDIA's next-generation platforms to even function. This is the narrative that has sent the stock up an incredible 90% over the last 3 months. The market expectation is built on the company's technology. Navitas doesn't make the brain chips, it makes the power chips. Specifically, it is a leader in next-generation power semiconductors using gallium nitride or GaN and silicon carbide or SiC. These materials are vastly more efficient, run cooler, and are much smaller than traditional silicon-based power components. As AI data centers become more and more power-hungry, the old technology is hitting a wall. NVIDIA's next-generation 800-volt architecture, which will power the future of AI factories, requires this new class of power chip. And on October 13th, Navitas announced a new suite of its chips specifically designed to support that exact 800-volt platform. The company itself projects that the AI power market will explode from 7 gigawatts in 2023 to over 70 gigawatts by 2030, creating a $2.6 billion annual opportunity for exactly what it sells. This is the story. It's clean, it's powerful, and it's tied directly to the biggest trend in the market. Now, let's challenge that. Let's look at the reality that has 24.6% of the float betting against it. The reality is that, while the market is pricing this stock for 2030, the company's 2025 financials are facing a jarring disconnect. While the AI story is fantastic, Navitas has historically made a lot of its sales from the consumer mobile market in China. Due to a combination of tariff risks, weak demand, and a deliberate company choice to move away from low-margin mobile business, that entire segment is in freefall. So much so that the consensus analyst forecast for Navitas's full-year 2025 revenue is not a gain, but a decline of 41.2%. Let me repeat that. The market is paying a massive premium for a stock whose revenue is forecast to be cut almost in half this year. This is the core of the bear thesis. The company is deeply unprofitable with a negative PE ratio and operating losses of over $100 million. The stock is trading at a forward price-to-sales multiple that some analysts peg as high as 55, when the industry average is closer to 8. The shorts are not betting that GaN technology is a failure. The shorts are betting that a $2.8 billion market cap is an indefensible valuation for a company that is currently unprofitable and guiding for a 41% revenue collapse. They are betting that the AI story is a 2027 story, not a 2025 rescue. This tension explains the stock's wild behavior. This 5.85% pop today is nothing. Just yesterday, the stock fell 5.9%. 2 weeks ago, it skyrocketed 21% in a single session. This isn't investing, it's a proxy war. Every trading day is a battle between the long-term AI narrative and the short-term financial reality. The volume is astronomical, with a 20-day average over 75 million shares. All of this is happening as we head straight for the next major catalyst, the company's third quarter 2025 earnings report, which is scheduled for after the market closes on Monday, November 3rd. That is the day of reckoning, where management will have to prove to the market that the new AI data center orders are ramping up fast enough to fill the massive hole being left by the declining China business. Now, let's talk about the short position in more detail because this is what so many retail investors are watching. When people see a 24.6% short interest, they immediately think of a short squeeze. This is where the story gets more complex, and it provides an actionable insight for anyone watching the stock. To understand squeeze potential, you cannot just look at the short interest percentage. You must look at the days to cover, also called the short ratio. Navitas's days to cover is currently just 0.9. What does that mean? It means that even with 45.5 million shares held short, the stock's average daily trading volume is so enormous that all shorts could theoretically buy back their shares to close their positions in less than one full trading day. A classic short squeeze happens when shorts are trapped in a low-volume stock. That is the opposite of what's happening here. Shorts can get in and out with relative ease. Here's the second actionable insight. Look at the borrow fee rate. This is the interest rate hedge funds have to pay to borrow the shares to short them. When a stock is hard to borrow and shorts are desperate, this rate can spike to 50, 100, or even 200%. According to the latest data, the borrow fee for NVTS is around 1.2%. That is not just low, it's practically free. It costs the shorts almost nothing to hold their positions. And wait, they are not panicked. They are not being squeezed. They are comfortably sitting in their positions, waiting for the November 3rd earnings call, just like the bulls. This presents a fascinating dynamic. On retail forums, you will see the bulls pointing to the 90% rally, the NVIDIA partnership, and comments from other investors saying they expect to see $30 a share next year. They see the 24.6% short interest as rocket fuel, believing those bears will be forced to buy. But the data shows the bears are entrenched, well-supplied, and paying almost nothing for their bet. What's your take on that 24.6% short interest? Is it smart money bracing for a correction, or is it fuel for the next leg up? This all brings us to the future outlook, which is incredibly binary. It all hinges on the earnings call in just a few days. In scenario 1, the bull case, CEO Chris Alexander gets on the call and announces that the ramp in AI data center sales is happening faster than anyone predicted. He gives a specific update on the 8-inch wafer transition, which will improve margins, and he guides for a massive acceleration in the fourth quarter and into 2026, making the 2025 revenue decline look like a temporary blip. If this happens, the shorts will finally feel the pain. That 0.9 days to cover won't matter if new buyers flood in and the shorts all try to exit through the same tiny door at once. The stock would likely break its 52-week high of 17.79 and never look back. In scenario 2, the bear case, the earnings call is a disaster. Management confirms the 41% revenue decline and gives a weak forecast for the fourth quarter. They talk about the AI opportunity in vague long-term language like a 2027 story, without providing concrete 2026 numbers. This would confirm the short thesis entirely. You would prove that the stock's valuation is completely unmoored from its fundamentals. The 1.2% borrow fee means the shorts have no reason to cover. They will simply add to their positions. In this scenario, the stock has no valuation floor. The analyst price targets that are currently at $8 or even $5.50 would suddenly seem very realistic. The 52-week low is 1.52, and while it may not go that low, the drop from 13.86 would be fast and brutal. So as an investor, you have to decide what you're betting on. Are you betting on the long-term multi-decade story of GAN and SiC powering the AI build-out, or are you investing based on the next 12 months of financial reality? Comment below what you'll be listening for on the November 3rd earnings call, AI data center revenue or the China market recovery. In the end, Navitas Semiconductor is the perfect example of expectation versus reality. The expectation is a world-changing technology, a key supplier to NVIDIA, and a stock that's part of the greatest technological shift of our time. The reality is a company with no profits, collapsing near-term revenue, and a massive and entrenched and very comfortable short interest that is betting the entire story is just too early. Today's 5.85% pop feels good for the bulls, but the real war for the stock has not even begun. That starts on November 3rd.